On this week's agenda, key inflation data in the monthly jobs report. Joining us now, Kevin Hassett, former chairman of the Council of Economic Advisors and distinguished visiting fellow at the Hoover Institution. What if someone gets hired like late Thursday night? It's not going to be in. How do they do it? They got, I guess, is it a? Don't tell me it's a model. They have a model for the jobs number we see on Friday, and releasing it on the before the month's barely, still warm, the month of August.
There's a survey day and or a survey week, and so they don't survey every day.
No. And it can be off by 300,000 jobs. That's like the standard deviation from the mean or something anyway. Is it, what are you expecting? Is it, we're looking for a data point that tells the Fed the lag you're waiting for is here, and the pause that you took and the sort of the caution that you've expressed over the last 3 or 4 months was warranted. Is that coming, or is it going to be we're back hiking?
No, I think that the hiking is coming again. That if you look at, there are a lot of real-time measures. GDP now at the Atlanta Fed has third quarter GDP at 5%. The inflation numbers are going to surprise on the upside because gas prices have gone up so much. And so we're looking probably for a top line CPI of 0.8 or so. And when those numbers come out, the Fed is going to obviously have to start talking about hiking again. And I think markets haven't fully digested that. But Jay Powell was warning about it, at Jackson Hole. He was saying things like, oh, well, we have to be mindful of risks. Well, if the Fed's being mindful of risks, that means that it's sort of wondering whether everything it's been signaling is incorrect. They're setting the stage for a reversal because the data are just so strong right now.
The economy needs to actually, do we need a recession for the Fed to breathe easier? And give me a Fed funds rate that would bring on a slowdown and that they think is essential to get to 2%. How high is that? We're thinking 25 more basis points. Are there going to be 200 more basis points that we don't know about or we're not factoring in? Kevin, could it get back to 6 or 7%?
Yeah, for sure, 6. The thing is that the best guide to the interest rate that you need to get inflation under control is this thing called the Taylor rule, after my colleague at Stanford, John Taylor. And, the Taylor rule has a bunch of parameters you got to guess. When I do the Taylor rule right now, I'm getting that it should be about 7%. And John thinks I'm a little high. I think that when we communicated about it, he thought it was more like 6. But the fact is that, think about it, Joe, we're likely, or it's possible, maybe 30-40% chance that third quarter real GDP growth is greater than the interest rate. And there's just no way that inflation is going down when you get something like that, combined with deficit spending that's just absolutely insane. And so I think, massive deficit spending, every economic model says inflation, GDP growth really high, it's inflationary. So, yeah, I think that the Fed is going to have to hike quite a bit more.
How much of this is fiscal, do you think, with what the Fed, with what the Biden administration has done? It used to be pandemic relief. Then we switched to, we got a lot of money for infrastructure to spend, a lot for the CHIPS Act, the IRA, that's just so funny what it's called. But, there's over $1 trillion probably in green subsidies or green initiatives. All that is going to, what's that? It's Keynesian, isn't it? Isn't that what's happening right now? Or is it just a solid underpinning?
Yeah, and there's like a simple way to think about it, which is just that if you look at like what nominal GDP is, and so if they spend, an extra 5% of GDP, which is about what they're doing, then nominal GDP goes up by 5%. And if you don't have the supply to match that, then you get inflation. And so the numbers actually make quite a bit of sense right now. I think that inflation is hanging out in the 5% range, and it's doing so precisely because the sort of traditional models of inflation are.
That would make sense to me because everybody's always wrong. That's the only thing you find out. So everybody's thinking maybe 25 or 50 more basis points. And what would be or if they're wrong, it could be that rates actually stay where they are or go down, or it could be the other thing, that the economy just stays strong and they got to go much higher than what we're thinking. And that recession is not. It's not that it's never going to happen. It's just not going to happen this year or maybe early next year. But they're going to keep having to raise till they actually bring one on. Could be late next year or the year after that.
Right. And don't forget that the fact that we have a recession doesn't mean that inflation is over. You go back to the 70s, what happened was inflation, went up to 7 or 8, and then we had a recession.
Yeah, that's even worse.
And the Fed backs off, and then inflation goes back up again. And so I think we're going to see kind of a sawtooth inflation cycle. It's going to be kind of like the COVID waves, where it feels like COVID's under control, and then there's a new variety. And right now, I think that we're seeing, we're going to see another inflation wave. That's going to be stimulated both by high growth and by higher energy prices.
Oh, my God. And don't tell me Jay Powell is Fauci. I'm in trouble.
I have a high